All right, welcome back, and thank you for staying with us. Now, as the times change and governments seek to raise more taxes, investor sentiment remains crucial. That's why in this week's segment, we look at how taxes can be used to lower the cost of doing business. As the country grapples with a raft of new taxation measures in the Finance Bill of 2023, we sought to find out how businesses can take advantage of the current taxation regime, reduce their cost of doing business, get tax exemptions, as well as ensure that they are aware of all the taxes a business is eligible to and how they operate. In my sit down with Caleb Mukaya, a tax partner from the SKM, I started by asking him to explain how turnover taxes work.
For startups, the tax planning mechanisms that exist. In the current finance bill, for example, we have what we call the turnover tax. The turnover tax is tax on sales or tax on turnover. It's been there for quite a while in the Kenyan tax space. The proposal in the finance bill is to review the tax rate that applies for turnover tax from the current 1% to 3%, which effectively means that if you make sales of 1 million and you are on the turnover tax regime, then your tax will be 3% of the 1 million in the proposed bill. Currently, the rate is 1% of the turnover, so it will be 1% of the 1 million. Which could be 10,000 shillings under the current regime if your sales are 1 million. In the proposed, in the finance bill, the proposed rate of 3% could then be equivalent to 30,000. The beauty of turnover tax is you do not need to be keen on tracking your expenses, because the tax rate is on the top line on your sales. So the tracking of expenses is really not a big issue for startups. The benefits which will apply to a startup will depend on the industry. Of course, government does, in a way, redirect investment based on incentives that the government has put forth. So if the government wants to attract investment in energy sector, for example, they will put more incentives into that particular sector. And the idea is to try and see if they can sway more investors to go into that particular sector. But generally, there are what we call incentives that cut across all sectors or most of the sectors. And from a corporate income tax perspective, we have what we call investment allowances. Previously, we used to call them, under the repeal schedule, we used to call them the capital allowances. So these are what we call, these are deductions you make against your top line or against your revenue, and they go into reducing the amount of profit that is subject to tax. A good example is if, for example, you are putting up a factory, and there is the cost of putting up the structure which abuts the factory, the machine. There is the cost of the machine. There is the furniture for the office. So all these have different rates of investment allowance, which reduce your profit. For example, if it's a factory, you are able to claim what we call investment allowance on the factory, on the building itself. You are able to claim investment allowance on the plant and machinery, 50% of the cost in year one of the cost to incur to procure the plant and machinery, 50% of the cost of the putting up the building, the structure, which abuts the manufacturing plant and machinery. Then on furniture, you are able to claim investment allowance on the cost of procuring the furniture. So all this will go into reducing your profit, your taxable profit, and therefore you pay less tax.
Mukaya also urges businesses to ensure that they are tax compliant to be able to reap some of the benefits, while cautioning them that although the business entity may be separate from the proprietor, the tax compliance of the director may have an effect on the business outlook.
For starters, if you are for beginners of proprietors who are beginning business, the first thing that they need to appreciate is tax compliance is very, very necessary, because at this point in time, even participating in some of the tenders, we have tenders which are classified, which are put aside for young people, young entrepreneurs. we have tenders which are general for and open for every other category, for every other person. So for the tenders which are put aside for young people and they are government-related tenders, you need a tax compliance certificate from KRA. And you cannot get that tax compliance certificate if you are not tax compliant. So one thing that proprietors and investors need to understand, young investors need to understand, is that tax compliance is very important, and they should cultivate and endeavor to be tax compliant from the very beginning.
As we wind up our conversation, Mukaya takes me through some of the reasons that may disqualify a business proprietor from accessing their tax breaks and incentives, as well as some of the common mistakes made by MSMEs in the process.
The major commission that we experience with most taxpayers, especially medium and small taxpayers, is poor record keeping. If you cannot demonstrate that you incurred a particular cost, then unfortunately, most of the time you have to lose that cost. The second one is failing to claim some of these costs within the prescribed timeline. So, for example, for VAT, you need to claim it within 6 months from the date of buying. For example, if you buy a particular input, that particular VAT relating to that input, you need to claim it within 6 months from the invoice date. The lack of appreciation of professional services by small and medium enterprises can also cost them greatly in terms of tax planning.